Hi, I'm Kara Murphy, and this is Money with Murphy. With the third quarter behind us, I like to take a few moments to think about what's transpired and what might be ahead of us. After a surprisingly strong start to the year for the S&P 500, the third quarter saw disappointing returns for a variety of asset classes. Stocks and bonds suffered losses, while commodities were a rare bright spot. And of course, since the close of the quarter, a devastating conflict has broken out in the Middle East. Unlike the first half of the year, when bigger, growthier stocks outperformed other shares by a wide margin, in the third quarter, large and small cap stocks, growth and value stocks retreated about 3%. The exception were small cap growth stocks, which fell by a much greater 7%. Sector performance was quite differentiated, and leaders shifted from earlier in the year. Technology stocks, for instance, had been clear standouts in the first half, but dropped by about 6% in the third quarter. The energy sector, by contrast, rose by 12%, helped by rising oil prices. The Federal Reserve appeared to inch closer to the end of its rate hiking cycle, even as some inflationary pressures remained. In July, the Board of Governors raised the Fed funds rate for the 11th time since early 2022. Then they held the rate steady at their next meeting. As economic growth appeared to re-accelerate, long-term interest rates followed the Fed's lead, and Treasury yields across the maturity spectrum rose. While economic growth has remained remarkably resilient and even in some cases grown stronger, higher interest rates are beginning to pinch in some areas. More consumers with credit card debt are falling behind in their payments, and more companies are declaring bankruptcy relative to what we've seen over the last few years. While these levels are not yet alarming, they do bear watching, particularly if the Fed expects to hold rates at these higher levels for longer. Last quarter, we discussed how uniquely concentrated the equity market had become. The 7 largest names in the S&P 500, sometimes called the Big Seven or the Magnificent Seven, were responsible for essentially all of the positive performance in the index in the first half of the year, while the remaining 493 names in the index were more or less flat. Given that enormous divergence, we'd expected that the market's leadership would change, and that's indeed what we've experienced in the last quarter. Going forward, we continue to look for opportunities in areas of the market that may have lagged. While markets may move up and down in the near term, a properly diversified portfolio, one that's aligned with your goals and objectives, remains the best way to grow wealth over time. So until next time, invest wisely and live richly.